Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the trades that actually matter. I'm Sam, and before we dive in today, I need you to stop whatever you are doing, because what I am about to show you is one of the most unusual setups I have seen in this market in a very long time. A company posts a $145 million net loss, misses analyst estimates by over 400%, and the market responds by sending the stock up 8% in a single day. Today, we are breaking down Keel Infrastructure Corp, ticker KEEL on the NASDAQ, a company that is burning its crypto past to fuel a future in AI infrastructure. We have got fresh Q1 2026 earnings data, institutional whale movements straight out of SEC filings, and a technical setup so loaded with squeeze potential it should come with a warning label. If you have been watching the AI trade and feel like you have already missed the boat on the big chip makers, stay locked in, because the picks and shovels play on this revolution might just be getting started. To understand why a massive loss triggered a massive rally, we have to go back to April 1st, 2026. That is the day Bitfarms ceased to exist. On that date, the company completed a full corporate redomiciliation to the United States and officially rebranded as Keel Infrastructure Corp. And I want you to understand something. This was not just a logo swap. This was a complete identity transplant. The market is no longer pricing this stock as a speculative Bitcoin miner that lives and dies by network difficulty and halving cycles. It is now pricing it as a land and power play. And here is the thing that most retail investors are still sleeping on. The biggest bottleneck in the entire artificial intelligence build-out right now is not chips. It is not talent. It is not even capital. It is power, raw, reliable, grid-connected electrical power at scale, and Keel is sitting on a 2.2 gigawatt pipeline of established energy infrastructure spread across the most stable grids in all of North America. That is the transformation that is turning a volatile, high-beta crypto name into what could become a critical infrastructure pillar. And investors are finally starting to price that in. Now, let us be really clear about why the old model had to die. The legacy Bitfarms business was essentially a weather vane for Bitcoin sentiment. Revenue was directly correlated to the price of a single volatile asset. When the coin dropped, the margins evaporated overnight. On top of that, they were managing a sprawling operational footprint across Latin America, Paraguay, Argentina, bringing with it genuine geopolitical exposure and regulatory headaches that no institutional allocator wants anywhere near their portfolio. That model is done. The new Keel infrastructure thesis is built on something fundamentally different, repurposing that same physical infrastructure, the land, the power connections, the fiber, the cooling capacity, and redirecting it toward AI and high-performance computing data centers. Instead of praying for a Bitcoin bull run, management is now targeting stable, long-term leases with hyperscalers, the Googles, the Amazons, the Microsofts of the world. They are trading volatility for predictability. And as we map out what they actually own right now, the scale of the geographic advantage they have quietly assembled becomes almost shocking. Wall Street analysts started raising their price targets the moment they saw this map, and honestly, I do not blame them. Keel has established 3 core regions in North America, and the crown jewel right now is the Scrubgrass site, where a 750 megawatt load study is actively underway. Just let that number sink in for a second. That single study at a single site significantly exceeds what most analysts were modeling for their entire combined capacity just 12 months ago. But perhaps what matters even more for the near-term stock price is this. They have achieved 100% zoning completion at their Panther Creek, Sharon, and Moses Lake sites. If you have spent any time studying the data center development space, you know that zoning approval is where projects go to die. It is the valley of death in this business. Developers lose years and hundreds of millions of dollars fighting local governments over permits and land use classifications. Keel has already cleared that hurdle at multiple sites. That is pure execution certainty. And for a hyperscaler looking to commit to a long-term lease, that kind of de-risked development profile is absolutely invaluable. This is why the stock is finally catching a serious institutional bid. And that bid has not been subtle. Take a look at the price action over the last 12 months. While the financial headlines were screaming about losses, the chart was quietly telling a completely different story. We are looking at aggressive accumulation. The stock has rallied over 75% in just the last 4 weeks alone. If you were holding this name over the full trailing 12-month period, you are sitting on gains north of 91%. On May 11th alone, shares jumped 8.3%, tagging an intraday high of $4.50. Now, here is the question I want you to really sit with. Is this just retail traders chasing headlines, or is something more structural happening beneath the surface? Because a sustained stair-step uptrend with consistently higher lows does not get built on retail sentiment alone. This is the kind of price structure that forms when a dedicated class of buyers is systematically accumulating a position over weeks and months. And in just a moment, I am going to show you exactly who those buyers are, and it might genuinely surprise you. Before we get to the who, let us look at the 3 specific catalysts that triggered 61 million shares changing hands on a single trading day, a volume figure that came in 86% above the 3-month average. The first catalyst was analyst validation. Chardon Capital initiated coverage with a buy rating and a $4.50 price target, while Alliance Global Partners came in even more aggressively with an $8 price target. When 2 separate analyst initiations land on the same day, it signals to the market that this story has officially crossed from speculative to investable. The second catalyst was what I would call the clean divestiture. The company closed the $13 million sale of its Paso Pe site in Paraguay, an official, documented exit from its non-core Latin American legacy assets. The market had been waiting to see management put actions behind their words, and this was the proof. The third and most powerful catalyst was the capacity shock. That 750-megawatt scrubgrass announcement was the lightning bolt that proved to even the skeptics that Keel is not positioning as a niche player. They are swinging for heavyweight status in the AI infrastructure space. 3 catalysts, 1 day, 61 million shares. The signal could not have been louder. Now, we absolutely cannot ignore the earnings report itself, because if you only read the top-line numbers, you would have panicked and hit the sell button immediately. Revenue came in at $37 million, actually a marginal beat on consensus estimates, but it was down 23% year over year. And the net loss? A jaw-dropping $145.4 million. So why did sophisticated institutional money send this stock higher on that news? Because when you dig beneath the headline figures, this was one of the noisiest transitional quarters you will ever see for a company mid-pivot. There was a $41.4 million non-cash charge from digital asset fair value changes. There was a $21.6 million loss on extinguishing their old Macquarie credit facility, debt that frankly needed to go away before they could operate as a U.S.-listed infrastructure company. Selling, general, and administrative expenses rose 52%, which sounds alarming until you realize they were simultaneously re-domiciling from Canada to the United States, converting their entire accounting framework to U.S. GAAP, and restructuring their corporate governance from scratch. That is not cheap. Legacy mining revenue declined $16 million, which is precisely the revenue line they are strategically walking away from. The market is not ignoring these numbers. It is correctly interpreting them as the cost of a transformation, not the symptom of a structural collapse. And none of that transformation math works if the company burns through its cash before it reaches the other side. So let us talk about the war chest, because this is the number that makes every single Q1 headline completely irrelevant to the long-term thesis. Keel is sitting on $533 million in total liquidity. That is $336 million in hard cash and an additional $197 million in unencumbered Bitcoin holdings. Management has communicated clearly and explicitly This liquidity position is fully sufficient to fund all priority data center development sites and cover total corporate overhead through the end of 2028. Read that again. They do not need to go back to the equity markets. They do not need to issue dilutive shares to raise survival capital. They have the runway to wait for the right hyperscaler deals at the right terms. When you are sitting on $500 million in liquid assets with a clear path to execution and no existential funding risk, a paper loss on a legacy credit facility is nothing more than a line item. The big institutional players know this, and that brings us to the most important part of this entire analysis. We need to talk about Jane Street Group. If that name does not immediately mean something to you, let me give you the short version. Jane Street is widely considered one of the most sophisticated and analytically rigorous trading firms on the planet. These are not momentum chasers. They are not Reddit-driven retail speculators. They run quantitative models that are the envy of every hedge fund in the industry. And they just disclosed through an SEC filing that they hold a 3.8% passive stake in Keel Infrastructure. That is over 23 million shares. Total institutional ownership has now crossed the 20% threshold. This is the smart money accumulation signal that technical traders dream about finding before the broader market wakes up. However, because I respect your capital and your intelligence, we have to acknowledge the legal risk sitting in the background. There is an active class action lawsuit alleging misleading statements made back in 2023 and 2024 regarding internal controls. Management says they will defend vigorously, and these types of suits are genuinely common during large-scale corporate transitions. But it is a legacy shadow, and you need to have it in your risk model. The traders, as the data clearly shows, are not waiting for the lawyers to finish their work. And speaking of the trading data, this is where the math gets genuinely exciting for anyone watching the short-term technical setup. Keel currently has over 72 million shares sold short, representing nearly 13% of the entire float. Now layer on top of that a days-to-cover ratio of just 1.78. For the uninitiated, that means if every short seller in this stock simultaneously tried to buy back their borrowed shares, it would take less than 2 full days of average trading volume to exhaust the available supply. This creates what traders call a highly reactive squeeze environment. NASDAQ Dorsey Wright currently assigns the stock a high technical rating, supported by a clean stair-step uptrend structure with well-defined higher lows at $3.80 and $3.50. Here is the question worth asking. What happens to those 72 million short shares the day a signed hyperscaler lease hits the newswire? Could this be the setup where short sellers get absolutely trapped with nowhere to go? The probability might be higher than the bears are willing to admit, but the short interest is only half of the technical story. The options market is screaming something even louder. Look at the put-to-call volume ratio, 0.21. That is an extreme skew. For every single person buying a put, betting this stock falls, there are nearly 5 people buying calls, positioning for the stock to move significantly higher. We are seeing massive strike concentration at the $4, $4.50, and $5 levels for the May expirations. This heavy out-of-the-money call buying is not random noise. It is aggressive traders positioning ahead of a potential breakout above that $4.50 local high. And this is where the gamma squeeze mechanics become really fascinating. As the stock approaches $4.50, the market makers who sold all those calls are mathematically required to purchase the underlying stock to delta hedge their exposure. That buying pressure pushes prices higher, forcing more hedging, which pushes prices even higher still. It becomes a self-reinforcing loop, a mechanical accelerant that has nothing to do with fundamentals and everything to do with the sheer weight of options positioning. So given everything we have laid out, the cash position, the assets, the institutional accumulation, the short squeeze setup, the gamma mechanics, what is the actual ignition switch that sets this all on fire? Management has been explicit about it. The single most important value driver for the remainder of 2026 is the execution of 3 signed hyperscaler leases. That is the year-end target. If they hit it, the crypto miner label gets buried permanently. The business transforms into a contracted infrastructure operator with predictable, recurring cash flows. And from there, the path to 2027 is about delivering actual megawatts from that 2.2 gigawatt pipeline. Here is the valuation question that should be keeping the bears up at night. If Keel successfully transitions to a contracted data center operator, why would the market continue valuing it like a speculative miner instead of like a data center REIT, a class of assets that trades at materially higher multiples? That potential multiple re-rating on top of any operational execution is what the $8 price target from Alliance Global is modeling. For those of you thinking about positioning, let us talk execution. The stock has been trading in the 410 to 415 range in pre-market sessions, which represents a constructive dip entry zone relative to the 450 breakout level you want to see cleared. Your hard floor, the line in the sand where the immediate bullish thesis is still intact, is $3.80. That level has been defended consistently throughout this stair-step uptrend. If you see a confirmed breakdown below 370 on heavy volume, that is your stop signal, and the short-term bull case needs to be reassessed. But as long as the structure holds above 380, the buyers are in control of this tape. The profit-taking roadmap has 3 levels. Target 1 is 450, immediate resistance, and the post-earnings intraday high. Clear that, and the gamma squeeze mechanics create a natural push toward target 2, somewhere in the $5 to $5.50 range, aligned with both the heavy open interest concentration and H.C. Wainwright's published price target. And if the company announces a signed agreement with a name brand hyperscaler, an Amazon, a Microsoft, a Google, target 3 is $8. That is not a fantasy number. That is Alliance Global's model price, based on a realistic comparable valuation to contracted AI infrastructure operators, a potential double from current levels, driven by a single press release. The asymmetry here is real. Before I give you my final take, I need to be direct with you about something important. Nothing in this video is financial advice. I am not a registered financial advisor. Everything discussed here is for educational and informational purposes only. Keel Infrastructure carries real risks: the pending class action litigation, the execution risk on hyperscaler lease negotiations, the remaining Bitcoin price exposure in their treasury, and the inherent uncertainty of any large-scale corporate transformation. Markets can and do move against even the most well-reasoned thesis. Always do your own due diligence, understand your personal risk tolerance, and never invest capital you cannot afford to lose. Please consult a qualified financial professional before making any investment decisions. Here is the bottom line, and I want to say this as clearly as I possibly can. Keel Infrastructure Corp is a fully capitalized bet on the most valuable, scarce resource in the entire artificial intelligence build-out: power. Their $533 million liquidity cushion makes the legacy mining losses structurally irrelevant and fully funds their 2.2 gigawatt pipeline through 2028 without a single additional share of dilution. The short-term trade lives and dies on that 380 support level. The medium-term catalyst is those 3 hyperscaler leases. And the long-term re-rating story, from speculative miner to contracted AI infrastructure operator, is the thesis that the Jane Streets of the world are quietly accumulating ahead of. In a market where power is the new oil, Keel may be sitting on one of the most underappreciated refineries in the entire infrastructure landscape. This turnaround is not finished. It is just getting started. Now, I want to hear from you directly. Here is my question for the comments section. If Keel signs even one major hyperscaler lease before the end of 2026, do you think the market re-rates this stock immediately to $5? Or does it need all 3 leases before the institutional money really commits? Drop your answer down below, because I genuinely want to know what this community is thinking. If this breakdown gave you even one new insight today, hit that like button right now. It genuinely helps this channel reach more investors who deserve to see analysis like this. And if you are not subscribed yet, what are you waiting for? Hit subscribe and ring that bell so you never miss a Smart Stock Sam deep dive. Finally, if this kind of work adds real value to your investing process, consider supporting the channel directly through YouTube's Super Thanks feature. Every contribution, no matter the size, goes straight back into the research and production that makes videos like this possible. Stay sharp, keep your stops tight, and I will see you in the next one.